Okay, welcome to Economic Principles, Week 3, Key Concept and Summary. During this week, we talked about production cost, business structures, and the perfect competition. Basically, we examine how businesses define their costs and the desired profit levels. And then also we discuss the region of cost, both in the short and long run. And finally, we identified the characteristics of a perfectly competitive market. So let's analyze these concepts in a little bit more detail for these economic principles, key concepts for week 3. When we define explicit and implicit cost, the accounting and the economic profit, it is different. Privately owned firms are motivated to earn profits, right? However, profit it is in accounting considered only the explicit costs, and the economic profit consider both the explicit and the implicit cost. Remember that profit is the difference between revenues and costs. When we analyze the production in the short run, we should remember that the production is the process a firm uses to transform inputs, let's say labor, capital, raw materials, into outputs, right? It is not possible to vary fixed inputs, for example, capital, in a short period of time. Thus, in the short run, the only way to change outputs is to change the variable inputs, let's say labor. A marginal product is the additional output a firm obtains employing more labor in production. At some point, employing additional labor leads to diminishing marginal productivity, meaning the additional output obtained is less than for the previous increment to labor. Mathematically, a marginal product is the slope of the total product curve. So, cost in the short run, for every input, let's say labor, there is an associated factor of payment, example, wages and salaries, right? The cost of production for a given quantity of output is the sum of the amount of each input required to produce that quantity of output times the associated factor payment. In a short-run perspective, we can divide a firm's total cost into fixed costs, which a firm must incur before producing any output, and variable costs, which the firm incurs in the act of producing. Fixed costs are sunk, and that is because they are in the past and the firm cannot alter them. They should play no role in economic decision about future production or pricing. Variable costs typically show diminishing marginal returns, so the marginal cost of producing a higher level of output rises. We calculate a marginal cost by taking the change in total cost or the change of variable cost, which will be the same thing, right? And dividing it by the change in output for each possible change in output. Marginal costs are typically rising. A firm can compare marginal cost to the additional revenue it gains from selling another unit to find out whether its marginal unit is adding to profit. In the other hand, we calculate this cost in the short run to have an idea on how we are doing in our activity, right? So let's do what it has to be, right? When we calculate the average variable cost by taking variable costs and dividing by the total output of each level of output, average variable costs are typically U-shaped. So if a firm's average variable cost of production is lower than the market price, then the firm will be earning profits if fixed costs are left out of the picture. Okay, so right now we will do the analysis then on the production in the long run. When we talk about production in the long run, we say that in the long run, all inputs are a variable, right? Since the mission marginal productivity is caused by fixed capital, there are no diminishing returns in the long run. Firms and organizations can choose the optimal capital stock to produce their desired level of outputs. In the long run, firms can choose their production technology, and so all costs become variable costs. In making this choice, firms will try to substitute relatively inexpensive inputs for relatively expensive inputs where possible, so as to produce at the lowest possible long-run average cost. This is specifically noted in the production technology, which refers to a specific combination of labor, physical capital, and technology that makes up a particular method of production. Economies of scales. It is also important in this concept because it refers to a situation where, as the level of output increases, the average cost decreases. Constant returns to scale refers to a situation where average cost does not change as output increases. And these economies of scales refers to a situation where as output increases, averages costs also increase. Now let's note about perfect competition and why it matters, right? In a perfectly competitive firm, basically we say that a perfectly competitive firm is a price taker, which means that it must accept the equilibrium price at which it sells their goods. In a perfectly competitive firm, attempts to change even a tiny amount of the more than the market price, it will be unable to make any sales. Because in a perfectly competitive market, there are thousands of sellers, easy entry, and identical products. So that is typical, let's say, in a market of TVs, right? So basically, most of TVs cost the same in the same price range model, right? It doesn't matter if it's a Sony or it's a Toshiba or it's a VCO. Every brand has very little room to alter their prices. So perfect competition means that there are many sellers, there is an easy entry, and exciting firms, and then products are identical from one seller to another, and sellers are price takers.